Before we go on with the discussion, let's take a quick look at another viewer's question that we received. It's from Tabo in Cape Town, and he asks the question, how often should I review my life insurance policy? Roland, would you like to respond to that?
Thank you. Reviewing your life insurance policies is something that should be done at least on an annual basis. Also in terms of life-changing events, things like buying a house, having a baby, getting married or divorced, all of these things impact in terms of the amount of cover that you need to actually cover for your specific needs of yourself and for your family as well. So in most situations, I would always say be in constant contact with an advisor, at least get annual advice, and whenever any situation changes, make sure that you contact your advisor, tell them what has happened, and from that position they can at least advise you correctly to make sure that your cover has been adjusted accordingly.
Okay. Now, obviously that's an annual basis and, like you said, life transitions. That comes from an advice perspective. Then we have to look at product. Now, Dylan, from your point of view, there's a lot of terminology, could I call it that, of old generation versus new generation. When a plan is going through a transition or an annual review with a client, of course they need to look at the existing policy, but there are other ones out there. Could you perhaps expand on the old versus new type policy?
Yes, I think basically what we should look at is within the financial planning process, you need to complement, you're building a portfolio for a client, so you're complementing the different products. And that's usually what takes place. From a life cover perspective, it's slightly easier than other benefits because life cover is life cover. There really isn't significant changes between life cover. What you have is different payment options and premium patterns, for example, methods in which you can pay. But the kind of cover that you can have stays quite consistent. The difference between the two is just trying to make sure that you marry the old generation, which would have components of investment in it, with the new generation, which is no investment and risk only. And I think if you can marry those two and complement the kind of cover with your plan around your financial needs, you actually, it's a sort of a match made in heaven.
A match made in heaven. Okay.
Sorry, I've got to jump in here, Sean. I have to slightly tend to disagree. Old generation products were really quite costly and quite expensive. And I think that is when the new generation products started coming into play. First of all, it's a lot cheaper. Yes, you don't get a cash value out if you cancel the policy, but you're paying less per month for that actual life cover. Now, what's happening with the older generation products is that a portion of your premium is going to pay for the actual risk, and the other portion of your premium is going towards an investment plan. However, what happens is that that investment plan, especially since markets have not been performing as well as what they used to back in the 80s, those kinds of plans have not been performing that well. So what happens is that your insurance or the investment portion of your policies has not been growing the way it should have been growing. In my opinion, it's actually better off to be in a position where a person actually separates their risk cover from their investment cover. I find that newer products on the investment market actually give you much more cheaper benefits or cheaper costs, so you're actually better off than trying to subsidize between old and new generation products.
Okay, so just to take a step back, what we're saying is old generation products basically had a risk element to them and an investment element. And depending how the investment element really played for you, it either benefited you or put you at a disadvantage. New age, we're just saying now that it's pure risk. So if you die, you get paid out. There's no cash values, no investment values, anything of the like. That's well and good. Of course, the question of insurability has to come through that. Now, as we get older, the likelihood of us getting healthier is probably not the case. How does that play out in the underwriting world?
That's a very important question, and we often see that where people have taken out policies when they were young and healthy, and then unfortunately something has happened, either cancer or a heart attack or another condition that actually makes them uninsurable or insurable but at a higher premium. And then it is up to the financial advisor to sit with the client to look at the options to see if it is still insurable, even if there's maybe a slight loading on the policy, because the cost of life insurance has come down over the last couple of years. It might still be worthwhile to either take out new cover or to replace a policy if it's going to be cheaper. It might even still be cheaper even with a loading. There are different premium patterns, there are different options, so it is actually best to just sit down with your financial advisor, look at your options and then take it from there.
So it's going to be a case-by-case basis basically.